welcome back to my channel. So today's video is all about how to make 100K in 3 years from options trading. Now I want to start by saying in advance that some of the content in this video, it may not be super beginner friendly, and I know many of my subscribers are new traders, so y'all, a few of these concepts are a little more advanced than what I usually discuss. Also, I'm not providing generic information in this video, so you won't hear me mention things like you need to set a stop loss, because that pretty much goes without saying, and for the most part, everyone is already aware of that. So I won't mention the basic things that most traders already know, and because of that, this investment strategy may be a little high level, but y'all know I'm always want to break things down in the most simplistic terms, or at least I try to. So just bear with me as I go through the information, and I'll try to keep some things at least an intermediate level. But y'all know if you have questions, I'm always willing to respond to comments and messages, so just feel free to ask. Alright, so to start, of course I want to give a breakdown of what the 100K plan would look like in terms of the financial aspect. So you can see, of course, we have the goals set. Now for monthly goals, you would see at $2,780, so $2,780 would be the ideal monthly target, with a weekly goal of $700 of profit and then a daily goal of $140 in profit. So if you were to meet these marks every single time you trade, there's 252 trading days in a year. That would give you $35,000 essentially over the course of a year. So a little bit over 35K. And then of course, if you multiply that by 3, that'll give you over $100,000 within a 3-year time span. Now, of course, we want to definitely keep in mind that some days, some weeks, some months are going to be like high or low, just depending on your profits and depending on how often you trade. And then, of course, if you lose trades, you may win some more than you lose. It may not be a consistent like 140 every single day, but it's very, very realistic. So my whole point in making this video is to pretty much display how easy it actually is to meet that 100K mark, because just making an extra $35,000 a year isn't super hard when you're trading. So seeing it broken down as a daily goal of 140, I'm going to show you guys exactly how you can do it. And I hope that this video is going to provide some value to a lot of people. Okay, so to jump right into it, the image that I have on the screen is going to provide a guide for breaking down different market patterns that traders commonly use to identify potential opportunities in both bullish and bearish markets, because it's talking about price action and the basics. So to give a detailed description of each one, I'm going to take you through the process of how you would evaluate them. So we'll start at the top with the rally-based drop. And of course, this is going to provide a supply zone. And this pattern occurs when price rallies upward. It forms a consolidation, which is the base, and then it sharply drops. So the base represents a moment of indecision where buyers and sellers are balanced. And the drop signifies that sellers are taking control and is leading to the formation of a supply zone, which of course is an area where future price rallies may encounter selling pressure. So traders look for the price to retest this zone before initiating a short position. So that's going to be the rally-based drop. So moving on to the drop-based rally, this is going to be a demand zone. So in this case, the price drops, it forms a base, and then rallies strongly. Now the base in this case represents the consolidation, or like a pause before buyers take over, and this pushes the price even higher. So therefore the movement creates a demand zone where future drops may encounter buying interest. Now traders often look for price to revisit this zone to enter a long position, expecting a bounce. Now moving on to the drop OB, of course that's going to be the order block. This pattern shows a drop in price, and it's followed by a small consolidation or order block, which is known as the OB, and then the continuation of the drop. So the order block is a small period of accumulation, and I'll talk about that in a second, along with distribution. And it's where institutional players make a large order, and the price often retests the order block before continuing the downward move. So traders see this as a point to re-enter a short position. Now moving on to the bearish gap, this forms when the price opens significantly lower than the previous close, and it leaves a gap in the chart. So you can see that here. And this indicates strong selling momentum. It's often driven by new market sentiment, and gaps are typically filled at some point, meaning the price may retrace back to the level of the gap before continuing lower, and this offers short-term trading opportunities. So I hope that one makes sense. That one can be a little confusing sometimes. So moving on to the structure retest, this one kind of goes without saying in a way. It's basically after a price moves away from a previous structure of support and resistance, it retests that structure before continuing in its new direction. So this pattern shows the price breaking out of a consolidation, then coming back to test the breakout level. And of course, a successful retest, it will signal the confirmation of the new trend. So traders often enter these positions after the retest, and that's a way to confirm the trend's strength. Moving on to the bullish gap, it's similar to the bearish gap, but in the opposite direction, of course. A bullish gap forms when the price opens significantly higher than the previous close, signaling strong buying momentum. The gap may be filled as price retraces downward, but the upward momentum usually resumes afterward, so that's the good thing to keep in mind. Now, traders look to go long near the gap or after the retrace of the gap zone. Now, in regards to the drop base drop, this is going to provide a supply zone. So this is a continuation pattern in a downtrend where the price drops, it consolidates, and then it forms a base, of course, and then it drops once again, creating another supply zone. And the base acts as a point of equilibrium before the sellers regain control and push prices even lower. Traders look for this price to retest the base or supply zone to short the market. So that's a good thing for anticipating the continued downtrend movement. Now, moving on to the rally-based rally, this is going to be a demand zone. So this is a continuation pattern in an uptrend, basically the opposite. So the price rallies, of course, forming that base of consolidation, and then it rallies again, creating a demand zone. So again, it's doing the same thing, but in the opposite direction. But this base represents a point of balance before buyers push the market higher. So traders may enter long positions on the retest of the demand zone, and they're expecting the rally to continue. Now, last but not least is the rally OB rally, of course, for that order block. And this happens when the price rallies, forms an order block, and then continues its upward momentum. So that movement just pushes up. So the order block, of course, reaches that level of like consolidation where it's just kind of up and down trading. And this is the area where large institutional buyers usually, they may be concentrated. So after the rally, the price often retests this order block before continuing even higher. This provides traders with that perfect opportunity, if done correctly, to buy on the pullback. So again, I know this is a lot of information at once. It may be a bit difficult to grasp these concepts, but in just a second, I'm going to give you guys some clear examples in Thinkorswim. So just bear with me as I go through the information. I know some of this is a little high level, but again, I'll always break it down for you guys. But to wrap this part up, I do want to mention that the price action patterns are key for traders to rely on technical analysis. And it's essentially going to show you when you enter and exit trades based on price movement alone. So each pattern represents potential areas of buying, which of course is demand, or selling, which is of course supply, and that's the pressure within the market. So with the zones such as like the order blocks and the bases serving as those key levels, those are going to be where prices may reverse or continue. So understanding these structures, it'll help you anticipate future market behavior. And of course, you can decide on how you would adjust your trading plan based upon learning these concepts. Okay, so next up, I want to discuss the 200 MA, which is of course the moving average. Now this is going to be a long-term trend indicator, and it represents the average price of any asset. So it could be a stock, ETF, whatever you're trading, over the last 200 trading days. And this provides a clear picture of the long-term trend. So it smooths out the price action to help traders identify where the market is generally moving up, down, or if it's sideways. So when the price is above the 200 MA, it signals that the market is in a bullish phase or uptrend. And then of course on the opposite side, when the price is below it, it indicates a bearish phase or a downtrend. So many traders view the 200 MA as a key level, and it's widely used in both the retail and institutional side of trading. So those strategies for like breakouts, above or below the line, it often triggers that large scale buying or selling. And of course, that pressure is a result when the price crosses the 200 MA, it can lead to increased momentum in the direction of the crossover. In addition to that, also the signaling. Again, you want to make sure you have all understanding of those key entry and exit points. And then additionally, with the 200 MA, it provides that time frame versatility because of course you can use it on various time frames to get a broader perspective on the price movements. In addition to that, the market context, that's going to be something that's very imperative when you're looking for more comprehensive trading to understand the indicators. And then, of course, the volatility filter. This is why a lot of people choose the 200 MA as like a baseline, because it helps filter out the noise during volatile market conditions. So again, I'm speaking on the 200 EMA because it's very important, and you'll see why in just a second. All right, so moving on to the 4 market phases, I definitely did not want to make this video without mentioning this because, again, we're trying to meet that goal. So we want to talk about the cyclical nature of the financial markets as they go through different periods, of course, of accumulation, uptrend, distribution, and then, of course, the downtrend. So to break these down, I'll go over each one. So the first one being the accumulation phase. This occurs after the market levels out from a previous downtrend. During this period, the price flattens as both buyers and sellers are undecided about the market's next move because there's, again, no strength on either side. It's just kind of in the middle. So the key things to remember are that the institutional investors or just standard investors, they're starting to accumulate assets at a discounted price. So the 200 MA is a key trend indicator because it begins to flatten, which signals a possible change in the trend. So the volume typically increases, not always, but usually, showing that the buyers are quietly entering the market and preparing for an uptrend. Now, the reason that this is significant is because this phase is often considered ideal to enter long positions as prices are relatively low and the upward momentum is expected to build. Now, the main thing to keep in mind for the accumulation phase is that the market is flattening near or just below the 200 MA. And this signals that consolidation after it levels out. Oh, and real quick, for anyone who's wondering what flattening means, it just simply means that the market is moving at like that stabilization. So it's little price movement, it's either up or down. It's basically a fancy way of saying a consolidation. So it's like an indecision between buyers and sellers because there's a pause in momentum. And often this precedes like a breakout or a trend reversal. So you would watch for flattening to anticipate any like market shifts that may be upcoming. So in reference to the uptrend phase, this is where the market begins to rise and it forms higher highs and higher lows. This signals the start of a bull market. So the key takeaways for this are that the price breaks out of the accumulation zone and moves above the 200 MA, confirming the uptrend. So investors may be a bit more confident, and the momentum traders jump in and it further drives the prices higher. So the optimism is that the market is going to be dominant and more participants are going to start buying as the trend gains strength. Now the significance of this is that the traders and investors, they often look for opportunities to ride the upward momentum. So it's basically like riding the wave up, and it makes it favorable as a time to buy and hold those positions. So all in all, this just pretty much confirms a new bullish trend. Okay, y'all, I hope y'all following what I'm saying. So we're going to move on to the distribution phase. And this is going to be where the market reaches a peak and the price begins to flatten once again and buyers start to lose momentum because sellers start to be dominant. This phase is marked by the indecision as the market could either continue higher or it could reverse. So the key takeaway is that the selling pressure becomes a little more strong and the profit taking begins because smart money investors, they often start to sell into the strength. So the 200 MA, it starts to flatten and it indicates the potential for a trend reversal. With that being said, the price action tends to be a bit choppy with a sharp move either up or down, or it could do both. And the significance of this is that the distribution phase is a warning sign that the market may be nearing the end of its uptrend. So traders may consider reducing long positions, so you want to scale out of your trades, or prepare for a possible downtrend. So you may just want to completely exit altogether. So the overall sentiment within the distribution phase is that around the 200 MA, buyers and sellers are pretty much at a balance, and this hints at the end of an uptrend. And then finally, the downward phase, this is going to be when the market begins to fall, and it forms lower highs and lower lows, which signals a bearish market. So sellers are in control at this point, and the prices decline steadily. So the key characteristics of this is that the price drops below the 200 MA, and it confirms the start of a downtrend. So there may be some fear or some people are panicking. They often dominate the market sentiment, and many investors start selling to cut their losses. So the market is characterized by strong selling pressure with fewer buyers willing to step in. And because of that, this phase represents the opportunities for short sellers or those looking to buy in at the bottom during the next accumulation phase. But the caution is necessary because the prices could continue to fall for some time before stabilizing. So below the 200 MA confirms the bearish phase. All in all, that's the most important takeaway for the downtrend. So although this may be a new concept for some people, I hope it makes sense in reference to the 200 MA and why I discussed it. So the accumulation and uptrend phases are generally viewed as buying opportunities, while the distribution and downtrend phases suggest caution or potential selling opportunities, which either way can show you that there's a shift in market sentiment. Alright, so with that being said, of course, I want to show you guys how to identify a downtrend. And again, I'll jump into Thinkorswim in just a second to show you what this looks like on the chart, but I want to provide the information, of course. So we're going to start with the highs and lows, and these are going to be foundational indicators of a downtrend. In this scenario, the market struggles to push the previous high points, and each rally is weaker than the last, as you can see on the screen. So sellers dominate at this point, causing each peak to be lower than the previous one. While buyers are unable to maintain the price levels, this leads to even lower dips. So traders look for a sequence of these highs and lows to confirm and of course look for sustained downtrend in the underway. It signals the bearish momentum. So a single lower high or lower low may not confirm the trend, so consistency is key. You always want to make sure you're reading the charts correctly to make sure you're staying consistent within that. Now next up is the Fibonacci retracement levels, which I've made previous videos about before, but to provide it in context of a downtrend, it's based on the ratios derived from the sequence that are commonly used to project the potential levels of support and resistance. So for example, the key levels are the 23.6, the 38.2, the 50, the 61.8, and the 78.6. So these are all going to be percentages. In a downtrend after the price falls, it tends to retrace some of the decline before continuing upward. So when you look at the fibs, these levels tend to find the possible retracement points where the market may reverse briefly before resuming the trend. So for instance, if the price retraces, let's say to a 38.2 or a 61.8%, the fib level will fail to break above it. And it's seen as a strong indicator that the downtrend will continue, which signals as an opportunity to short the market. So next up are the support levels, and these represent a price point where demand has historically been strong enough to prevent the price from falling further. In a downtrend, the breaking below the key support levels is a crucial event because it signals that buyers are no longer willing or able to defend that price, and the sellers are gaining more control. So this breakdown leads to further selling pressure as traders react to the broken support. So on the other side, when the price approaches support in a downtrend, some traders might anticipate a bounce, but the inability to maintain that support level often leads to an acceleration of the downtrend, so it can continue to go even further down. So the multiple tests of the same support without a successful rebound, it makes the level weaker, and it indicates that a strong downward momentum is essentially going to be imminent. So following that, I do want to discuss the channel patterns, and this occurs when the price moves within two parallel lines. So you can see that here on the screen, and it represents both support, which is the lower line, and resistance, which is the upper line. So in a descending channel, the prices make lower highs and lower lows, bouncing between the channel's boundaries. So the key aspect here is that the angle of the channel, it demonstrates the strength of the downtrend. So the steeper that the slope is, the more aggressive that the downtrend momentum is. So traders often use channels to identify the selling near the upper resistance line, and it covers the positions near the lower support line. So the break of the channels of those lower boundaries, it signals a continuation of the downtrend, and that just provides additional opportunities for traders to pretty much capitalize on the further price decline. All right, now flag patterns are probably the more popular one that you will see often, and this shows a brief consolidation or like a counter trend. After a sharp decline, the market may pause for a second and it moves sideways or slightly upwards and it forms a flag shape. And this happens because the market is temporarily balancing out demand and supply before making another significant move in the direction of the prevailing trend. So traders view the flag patterns as signals that the downtrend is about to resume. So when the price breaks down from the flag, it's often followed by another strong move lower. So a flag pattern is typically seen as a pause, and it can be a full reversal, but not necessarily. It just makes it a key setup for traders to look to jump into a trending market based upon what they see on the charts. All right, so in reference to volume, this is one of the most important confirmations of a downtrend in my opinion, because a downtrend with increasing volume, it suggests that sellers are gaining strength as more participants are selling at lower prices, which then indicates the confidence of the continuation of a bearish market. So conversely, if the price retraces higher on lower volume, of course, it suggests that the buying pressure is weakening and the downtrend is likely to resume. So when the volume spikes, particularly during a breakdown of the support levels, this often confirms the validity of the move. On the other hand, if the volume decreases consistently during a downtrend, it could indicate exhaustion where the market may be nearing a reversal, and traders should remain cautious at that point. So moving on to the MAs, these of course are going to be the moving averages to help smooth out price data by creating a constant update on the average price over a certain period of time. So this can be the 20, 50, or 200 periods as I just discussed. And this is going to also show you the simple moving average, and it gives more weight to recent prices depending on which one you're using, and it makes it more responsive to current price changes. The slope of the moving average line is pretty much essential to know that if it's downward, it reinforces the trend. And the moving averages are often used to identify long-term sentiments. Now, when looking at an EMA crossover, this occurs when a short-term moving average, such as like the 50-day, when it crosses below a long-term average like the 200 MA. This crossover in technical analysis is a strong indicator of a prolonged downtrend. So this happens and it signals that recent price movements are weaker than the long-term trend, which confirms the bearish market once again because the momentum is on the side. Now, many traders use this as a signal to either enter a short position or, of course, you may want to exit a long position. So additionally, combining crossovers with other indicators, it could be like momentum oscillators, or if you want to combine it with like volume indicators, it can also further validate the strength of the downtrend. And finally, the Elliott waves. This suggests that the market movements can be broken down into a series of 5 waves during trend periods. In a downtrend, the waves are 1, 3, and 5, and they move lower, representing the primary movement of the trend, while waves 2 and 4 are corrective waves that move against the larger trend. And then wave 3 is typically the longest and sometimes the strongest wave in a trend, and it's marked by increased momentum and volume. So the Elliott wave analysis, they look for these patterns to forecast and of course project the future price movements. And this helps to identify whether the market is in the wave structure traders are anticipating or when the market is likely to resume its downtrend movement. Typically, I would say it's at the end of waves 2 and 4, and the position is according to what you would see on the chart. So again, y'all, I know this is a lot of information, but we definitely need to know all of this, again, for my strategy. And if you're a new trader, these are going to be very significant things you can do. Now, in regards to these 9 that I just went over, the strongest downtrends typically align with multiple signals, so just keep that in mind. And it's going to be things such as like lower highs and then lows combined with a moving average. It could be a crossover or a breakdown of support with high volume. So just keep understanding these concepts, and this will give you a strategic edge to capitalize the market. Even if it declines, you can protect your portfolio from further losses. I have Thinkorswim pulled up and I have Square here on the chart. And I want to provide an example of how you would look for an uptrend. I know I just discussed how you would look for a downtrend, but I want to show you how easy it would be to enter into a trade without having to have an extensive amount of knowledge. You just need the basics, and then of course you need to understand how to read the charts. Again, we're only looking to make $140 a day to meet the goal of making 100K in 3 years. So I'm not saying that you shouldn't learn the charts and you shouldn't understand them in depth. I'm saying that you don't have to be a master to start to make money. Now, it does take more than just looking at a couple patterns, but we'll discuss that in a second. So I want to go ahead and take a look at this range right here after lunch so I can give everyone full context. Now we see that around this particular time at 1:16 p.m., we see that there's going to be a bearish candle. Of course, it was in an uptrend up until then, but we're going to talk about essentially what you would see in terms of the signals. So we see it's in a bearish candle at 1:16. The stock continued to fall all the way down. We see a doji here, which is a signal of a reversal, not always, but likely. And then we see that there was a small bullish candle. And then, of course, it had some volume to back it, but not a significant amount. The stock was kind of choppy for a little second or two. And then we look at these two candles here, which is where I want to focus on. At 146, we see a bearish candle that is small, supported by very little volume. And then at 148, of course, I'm on the 2-minute chart for anyone wondering. Y'all know I like to trade off 2 minutes. We see at 148, the stock is going to have a significant push up with this bullish candle here, supported by a ton more volume than previously, right? So we see that. So with that being said, these two candles are going to show us a pattern, which I've talked about before. And this is going to be in terms of a bullish engulfing, meaning, let me zoom it in. You can see here that this candle, again, having very low momentum, very low volume, was very small. And then, of course, we see that the following candle completely engulfed this candle. And this lets us know that there may be an end to whatever that particular trend is. And in this case, it's going to be the end of a downtrend and significantly showing us that an uptrend is soon to come. And that's exactly what happened, because we can see that happening here. This particular candle pushed up. It continued to rise. Now, some people may say that's not a significant move upward. It went from $67 up to $68. Okay, what's the big deal? But I'm explaining it in this terms because honestly, you don't need a whole ton of motion and movement to make $140 a day. Let's say, for example, you've seen this particular setup and you thought it was high probability. It made sense. If you were to look at this and then analyze it and then say, okay, I want to hop into this trade. Let's say the delta is at a 0.5. Typically, that's what you'll see for a good delta. You could essentially buy 3 contracts and make $150, $200 a day if you were to do this correctly. You just need to know how to read the charts. Now, again, I'm not saying just hop into trades aimlessly without understanding different rules and different contexts of things, but I'm saying you don't have to make it as difficult as some people may say you do. Again, this is going to be a bullish engulfing, a pretty good example of how you can essentially hop into a trade, make some quick profits, and hop out. You don't have to stay in trades forever. Now, I don't want anyone to think that you shouldn't have indicators pulled up. I completely have a bare chart just for the purpose of the example. So I hope this makes sense. Okay, so I know some people are still watching the video thinking to themselves, okay, what else? Like, what else do I need to know? Again, this is a very complex thing, but it's not as hard as some people make it out to be. Again, you only have a goal of reaching like $140 a day, and that will get you to 100K in 3 years. So with that being said, if you're brand new to trading, I have 30 topics on the screen that are going to be useful to study in trading. And these are going to be different things that are going to be beneficial to learn. And if you can master these things, then essentially you're putting yourself in a better position in order to hit that goal. So when we look at things that I've talked about, some of the things, again, I've already talked about the EMAs, the Elliott waves, and that I've made videos about the option Greeks before. In this video, I've talked about support and resistance and, of course, those zones. So, of course, these are going to be important elements. Therefore, I'll make future videos discussing all of them. So if anyone needs to go ahead and take a screenshot, feel free to do so. These are going to be the main things that I use in order to be profitable as a trader. Learning these concepts and understanding them in full detail is the best thing you can do, in addition to reading the charts and learning how to read patterns. All right, so in addition to that, I also want to show the trading indicators that I feel are important. Now, these are not going to be an exhaustive list of things. However, they are a few that are very important if you're brand new to trading. These are going to be the ones that you look at in terms of understanding those basic concepts first. So, for example, like the MACD is going to provide buy and sell signals. RSI is going to tell you if the stock is overbought or oversold. Bollinger Bands are going to be volatility levels, and so on and so forth. So I want to show this as well. So if anyone needs like a reference guide, you can come back to this particular video and look for the trading indicators that I've mentioned, because these are going to be super important. All right, y'all, to wrap it all up, I definitely want to give you just an overview of how to master trading in the long term and just give you some of the tips and some of the things to remember. So, of course, first things first is build a rule-based trading plan. Y'all know I always stress the importance of making sure you have a plan before you start trading. You don't want to just hop into trades just aimlessly. You want to have a plan first. And then of course look at position sizing and so on and so forth. So again, I always focus on having high probability setups. You have to know when to stop trading. Of course, be consistent. Focus on that rather than the money. Of course, it will come, but the consistency is key. And then learn through action, not by feelings. Always remove your feelings from the trades. And then the most important thing that I always stress is read the charts, learn the charts, and you will master the charts. So with that being said, that'll pretty much do it for this video. I thank y'all so much for watching. Thank y'all for all the love and support. And if you found this information to be helpful, feel free to leave a comment down below. And as always, I thank y'all so much for watching, and I'll see y'all in my next one.